stock market peaks is not predictive for the fact that the stock market's about to fall off a cliff.
Determining how you should invest throughout different stages of your life can be incredibly overwhelming and complicated, but it doesn't have to be complicated. In this video, Shaun and I are going to briefly discuss 4 simple investing concepts that you can apply to your own investing decisions. And to do this, we're going to look back at decades, I think in some of the data, close to a century of stock market data.
Josh, I know you watch the news, BNN, Business News Network and Bloomberg. You're constantly researching, trying to find out what the gurus are talking about in terms of the markets and what they're going to do. So do you have some pretty good predictive ability about which sectors, what stocks, or even geographic areas to invest in?
Exactly. I have really good predictive ability, but that's kind of leading us into what I want to talk about first, which is diversification and predicting different geographic areas or different countries to do well. And to do that, we're going to look at, I think, one of my favorite slides ever in Dimensional calls this the randomness of global stock returns, their Skittle chart. And likely, like you've said, we've all heard news stations talking about different countries that are apparently amazing markets to be invested in. But the real question is, does the data back that up? So let's take a look at the chart that I've pulled up here. So what we're looking at here is a chart with all developed countries. Obviously, who decides which developed countries are on this list? The people who made it decide that. But at the top there are the highest performing countries, and at the bottom are the lowest returners. So as we can see, for example, there's no predictable pattern. It's just a straight up Skittle mess. And so if we look at New Zealand, highest returner in 2019, but the lowest in 2021. Denmark was the highest in 2015 and the lowest in 2016, there in green. So what can we say about this? Past winners don't stay at the top. Performance is unpredictable year by year, and chasing last year's winners is a clear mistake. Now, if we look at the same idea, if we look at sectors, what do we see? Do we see sectors that are predictably better than other sectors? And
well, surely that's predictable.
Oh, absolutely.
Maybe geographic, predictions are tough, but surely, isn't tech going to be the home run next year? Or what about
it's
gold?
Always the best, right?
Gold stocks have done amazing. So maybe that's where we should be. What do you think?
Hey? Yeah, no, exactly. Well, it's a great question. So if we look at the same thing, data from the last 10 years, so from 2015 to 2024, we see the same story. There's no predictable pattern to the sectors. No sector stays dominant. One year it could be tech, the next it's energy. And stock sector leadership can be massively impacted by economic, political, market forces that make predicting the future almost impossible. Now, obviously, we're not getting into the weeds on this. It's pretty surface level, but I think it's pretty clear that if your philosophy around investing is to predict future sectors and for those sectors to outperform, you have a really difficult job to do.
So if you can't predict geographic regions and you can't predict sectors, and if the evidence is that the experts have a pretty tough time doing it, what's the solution? What are we supposed to do as investors?
Well, I think the solution, and probably people watching this video have heard this a million times, is to own a little bit of all of them. And it might not sound fun or exciting because you're going to have the average unless you're overweight in one, but it takes away the guesswork. Over the long term, average is, by the data, not average. The real worry in this whole situation is that you go all in on one sector and it performs poorly, and you miss out on other sectors that drive returns. So the best idea is own a little bit of each of them, whether that's geographical diversification or sector diversification.
Yeah, it speaks to the issue is sometimes when you talk about diversification, some people think it's code for diversification, when in fact,
right.
Yeah, you need to own everything. So when the thing does well, that drives the performance in your portfolio, you own it, and you didn't have to pick it because you were there no matter what. So yeah, I think that's a great illustration.
And a little bit of a side note here, but we've been seeing, especially in my generation, this idea of home run investing, right? Where they're kind of pessimistic about their opportunity to maybe pay for school or education or own a home or have enough for retirement. And so they go all in on maybe one sector, and they don't realize the riskiness of that strategy. But in their mind, it's like, well, I can't save enough for retirement anyway, so I'm just gonna go all in on tech. It might do really well. I'm gonna go all in on crypto. I'm going to go all in on AI, right? And so It's not sexy to diversify, but it's by the data a way better idea.
Yeah. Yeah.
All right. So after that very positive set of slides, we're going to dive into the two concepts that Shaun is going to talk about. And I know he gets this one question all the time. Shaun, is it a good time to invest? I mean, we all ask it. There's some theory behind it, and he's going to share that with us.
Yeah, ironically, maybe not ironically, but there's probably never a bad time to invest. But I would say that very often the question I get is, the stock market's really high. I'm not sure that it's a good time to invest. Things look expensive. Should I sit on the sidelines for a while and wait for a correction? So stock peaks, which happen all the time, create inertia where people don't want to invest. And that's bound to happen. We've talked about the data in previous videos that 75% of the time the stock market's up, 25% of the time it's down. And so a perennial question is, wow, the market's been doing pretty well. It's been doing well in spite of the tariffs and other things going on around the world. Should I just stay on the sidelines or invest? And the data confirms something pretty clearly, is that using stock market peaks is not predictive for the fact that the stock market's about to fall off a cliff. In fact, if you look at the historical data, and this goes over 1 year after a peak, 3 years after a peak, and 5 years after a peak. If you look at this chart that I have on the screen, 1 year after the peak, if you look at the kind of the greenish color bars, the market peak was up 13.7% 1 year after the peak. And the average of all periods was 12.5%. And if you look at 3 years later, the peak market was up 10.6% compound annualized. And the average of all markets is 10.7. And 5 years later, they were they were identical. So there is no predictive value of looking at the stock market valuations today and using that as a proxy for whether you should be investing in the market. In fact, the data clearly shows that if you have money to invest, you're probably not going to be well served by trying to be fancy or dipsy doodling in, or sitting on the sidelines or moving in money once in a while. Even dollar cost averaging, which people use, is probably not a productive strategy. Now, in saying all that, there is nothing wrong with taking a cautious approach to allocating cash to the market. We have clients all the time. They sell real estate, they sell a business, they have a pension plan that they have to deal with, and they're in cash, and they want to take a slow dollar cost averaging approach to building their portfolio. And we will do that. But at the same time, the clients need to understand that that likely is going to hurt their long-term performance. And what they might say to us is, you know what, Shaun, I get it. But you know what? I'd rather sleep at night. What if we had a terrible correction right at the beginning of me allocating this capital to the market? I'd rather go slow but sure. And if the market does well and there's an opportunity cost, I'm okay with that. I can leave those profits on the table. So doing this whole market's at a peak, is it about to fall off a cliff kind of planning is not productive. The only reason that you would nuance into the market, like I said, is you just want to be defensive and you want to have an insurance policy before you start allocating in the market. So you do it slowly, but that's not borne out in the facts that that's a productive strategy.
Yeah, that's a really good point. All right, so your second point here, it's on the cost of trying to time the market. What do you mean by that?
Well, again, it's a little bit like the previous slide in that, again, people are trying to use the news, the economic tea leaves, reading those leaves, trying to decipher whether it's time to be in the market or out of the market, or the tariffs are coming, or the tariffs are now over, or the jobs reports was great or it wasn't great, geopolitical events, wars, and people are going in and out of the market in response to the headlines. And it's very common. We see it in the data. Most large investment manufacturers, the Vanguards of this world, BlackRock, iShares, they can tell you categorically that they can see the cash flows. And retail investors typically are selling when markets are correcting, and they're buying back in when the markets are at a high, because they are using that as maybe a prediction as to future highs. But the reality is, the best strategy, as simplistic as it sounds, is to stay fully invested. The chart that I'm showing you right now is looking at the Russell 3000. So it's a broad stock market index between 2000 and 2024. And if you look at the market, that 25-year period, if you stayed fully invested and you put your $1,000 into the portfolio, it grew to $6,604. If you missed 1 week, the best week over that time period, it dropped to 55.11. And if I missed 6 months, the best 6 months over that time period, that's a long time. Be easy to miss 6 months if you're trying to watch the news and this is a good time to invest. You had a return of $4,286. That was a difference of 35% less growth per $1,000 invested. It's extraordinary. So the data confirms if you're going to commit to equities, be disciplined, stay fully invested. There's all kinds of strategies you can employ to deal with risk. But one of them is not to be going in and out of the market based on your hunch on what's going on with economics or capital markets.
Yeah, I think that's a really good point. A lot of us, when we're investing, we don't realize that to time the market well, we have to make two really good decisions. We need to get out of the market at the right time and then also get back in the market at the right time. And a lot of times when you talk to people who have gotten out at the right time, and they love to let you know, and you ask them when have they got back in, they haven't got back in yet. And so it's really, really difficult to do. And by the data, it's best to not exit the market. But
Yeah, no, exactly. So as we go through these ideas, investing doesn't have to be complicated. There's just a lot of common sense ideas that should inform your approach to investing, and particularly in retirement, it's even more important because you're moving from an accumulation phase and you've got time to a deaccumulation phase, and you have to be much more intentional and structured with your portfolio. So if you'd like to apply some common sense ideas to your retirement investment portfolio, make sure you reach out to us. There's a link in the show notes. You can find out how you can get a complimentary gap conversation about retirement planning and ideas that might be helpful for you. And there are free resources as well. So make sure you visit the website to grab those.
Awesome. All right. If you have any comments, leave them down below. We'd love to hear your thoughts. Maybe you disagree with us. Let us know. Take care.